We know you've been watching the markets and you probably aren't feeling all that great about things. Markets had their worst first half of a year in 50 years. And don't forget about the record inflation and an unprecedented rising interest rate environment. All of this together makes for a very challenging market cycle. Let's turn these challenges into opportunities and focus on what you should be thinking about to take advantage of this market correction. We know that whether markets are up or down, there are opportunities. So before we dive into those opportunities, let's just take a look at where we are year to date. 2022 has certainly been a challenging year in the markets. As we stand today, if we think about the three major indices, the NASDAQ, the Dow Jones, and the S&P, they all have had significant corrections this year. Right now, the NASDAQ is down around 31% year to date. The Dow Jones is somewhere around 12% down, and the S&P 500 is right around 20% down year to date. When it comes to those three major indices, the one I like to lean on the most is the S&P 500. The NASDAQ and the Dow get a lot of attention, but they're a little bit specialized. The NASDAQ is very technology focused, and the Dow Jones only has 30 companies represented. So those indices can perform on their own regardless of what the overall markets are doing. I like to focus on the S&P 500. There's 505 companies in there, and to me, that gives us the greatest reflection of what the overall markets are doing. It's important to separate the markets from the economy. The markets are exactly what we're talking about. What are these major indices doing? What are your investments doing on a daily basis? The economy is more of a reflection of some of the metrics. We talk often about, what's the GDP? And there are predictions out there about a recession, meaning we've had 2 consecutive quarters of negative GDP. Is it truly going to be a recession? Well, we don't know that for sure, but even if it does, that doesn't necessarily mean that the markets are going to go down further. They may have already reacted to that potential recession within our economy. We all remember the COVID correction. March of 2020, the S&P 500 itself went down around 35% in a matter of 22 or 23 trading days. But yet for the year, 2020 was a positive market return. And now here we are in 2022 having a significant market correction. So as we talked about, these causes are all different. But what have we seen following these market corrections? We've seen significant returns in the market. We've had very positive years. 2003 was a really strong market, 2009, 2010, 2020, and now what have we seen every time following these market corrections? 2003, significant strong market returns. 2009 and 2010, following that Great Recession, really strong market returns. So we've seen this every time. But the challenging part is we never know when these market corrections are going to start. We don't know how bad they're going to get, and nobody can tell you how long they're going to last. So what's important when it comes to investing is to ensure you have a plan and you feel confident about how you're investing and how you're designing your portfolio. I'm a retirement planner, and we help our families build comprehensive retirement plans. As we help them make their investment decisions, we take them through a process. One of the core philosophies of our investment planning component is transparency. Well, what exactly do we mean by transparency when it comes to your investments? We help our families understand exactly how much risk they're taking so that they know exactly how much exposure they have in the markets. We know we can't control the overall markets, but being intentional and having transparency around your investments, you can control what we expect your portfolio to do in any given market cycle. We use tools. Tools are a big part of that process. So that information is out there. You want to be prepared for the unknown. As I said before, markets are going to go up and markets are going to go down. Let's make sure you feel good about how you're investing and that you're taking an appropriate amount of risk for the stage of life that you're in. What we try to help our families focus on is what we can control versus what we can't control. That's the value of having a plan versus not having a plan. You can build a recession-resistant portfolio. It shows in time periods like this. As I mentioned before, it's easy when the markets are going up. We've had roughly a 13-year bull market since the end of the Great Recession. But now, 2022 has opened our eyes a little bit to exactly what markets can do and what it means to take on investment risk. Let's focus on the opportunities that are there in a down market. One of these opportunities is Roth conversions. Well, what exactly is a Roth conversion? It's where you pick up some of your pre-tax retirement balances and drop them over into a Roth. The amount that you move over shows up as taxable income for that year. If a Roth conversion makes sense for your tax plan in a given year, it makes a whole lot more sense in a down market. The reason why is that now you can move over the same number of shares or units that are now less valuable because of the market correction, move those over to a Roth. You can get those same units and shares over to a Roth vehicle, and you were able to lessen your tax liability on that conversion. Or if you were targeting a certain dollar amount, say $50,000 for a certain year, well, now you're able to get more shares or units moved over as part of that conversion. Once you have those investments over into a Roth vehicle, they're going to continue to grow. If they're in a Roth when this market corrects, that's where the advantage is so powerful. What's the tax rate on these Roth vehicles? Well, of course, it's our favorite tax rate, 0. So if you can get that market correction within Roth, well, now you've got that much more tax-free dollars within your overall retirement. Another opportunity to consider in a down market is to look at your contributions. If you're saving into a 401k plan at work, you have that new money going into certain investments within that 401k plan. Maybe some of them are lower risk or moderate risk, and maybe some of them are higher risk. Now can be a great time to consider dialing up the risk on all those new contributions and maybe reallocating to a higher risk investment. These higher risk investments are down considerably year to date. Now we get a discount. The investments are on sale. So this new money can go into a higher risk investment that are on sale. And then when these markets recover, you're going to see that much more growth in these new contributions. You want to make sure you've got the risk appetite to do that. You may not want to rebalance your existing entire 401k balance. That might be more risk than what you're willing to take on. But for your new contributions, it can be a great way to take advantage of these down markets. Another opportunity in a down market is to review your overall plan and investment strategy. We know it's easy to take a lot of risk when the markets are doing well, but the challenging time is to be at that same level of risk when the markets are down. So pay attention to how you're feeling right now. Are you staying up late, losing sleep, or are you nervous to log in and look at your balances? This can be the time to understand how you're reacting. How are you handling a market correction? And then when the timing is right, that is when you can make the necessary changes to align with your risk appetite and what your plan is calling for. We know these markets will recover. The unknown is just a matter of when and how long it's going to be before we get there. But the markets will set new all-time highs at some future point, and it's important for your financial picture and your overall retirement plan that you're taking an appropriate amount of risk and you're set to participate in those market recoveries as much as possible. We are in the midst of a significant market correction, but we know, as always, we will get past this. The markets will recover. You want to make sure that you are set up for your portfolio to maximize the return for the level of risk that is the best fit for you. If you have questions about your portfolio design or your level of investment risk, feel free to schedule a 15-minute retirement checkup call with myself or another retirement planner here at Merkle Retirement Planning.